Chapter 10 Property, Plant, and Equipment and Intangible Assets. The valuation about acquisition. In this chapter, we are going to cover two important operating assets. One is property, plant, and equipment. Usually we use PPE as the abbreviation. And the valuation of intangible assets. There are three types of long-lived and revenue-producing assets. Revenue-producing assets also named as operating assets. So the property, plant, and equipment includes land, buildings, equipment, machinery, furniture, trucks, autos. So these assets have physical substance. The purpose of these assets is to generate revenue for operating purpose. Natural resources, including oil and gas deposits, timberland, mineral deposits. Intangible assets, including patents, copyrights, trademarks, franchise, and goodwill. Intangible assets lack physical substance. These assets all reported in non-current assets section because they are all long-lived. This is an example of the notes related to the PPE from Microsoft. We can see the details of the property, plant, and equipment in the past 2 years. The PPE includes land, buildings and improvements, leasehold improvements, computer equipment and software, furniture, and equipment. These are total cost. That's the amount of value when these assets are acquired. Most assets are subject to depreciation. They accumulate depreciation. The difference between PPE at cost and the accumulated depreciation is the net book value of PPE. Land is not depreciable because it has infinite useful life. In this note, also from Microsoft, it reports the details of the intangible assets. These intangible assets are classified as technology-based, customer-based, marketing-based, and contract-based. We can also compare the balance of 2 years to see the change of each account or each asset. In the following slides, the table shows us the type of assets, the descriptions, their typical acquisition cost. So this column introduces the typical costs that are part of the acquisition cost. For example, equipment. The cost of equipment includes the purchasing price, sales tax, cost of transportation, installations, testing, trial runs, and reconditioning. So the book value of newly acquired equipment is the sum of all these costs. Basically, these costs are necessary or required to get these assets ready for intended use. The next example is land. When the company purchases a land, it reports the purchase price, attorney's fee, title fees, recording fees, commissions, back taxes, so on and so forth. These are expenditures, all as part of the acquisition cost, or the book value of the assets when they are acquired. You can read the descriptions for the following long-term assets, also the intangible assets. So in summary, the book value or the acquisition cost of these assets is not just the purchasing cost. It includes all the required expenditures that get these assets ready for intended use. Without incurring any of the expenses, the assets cannot be used, or the assets are not ready for use. If the company does not pay that title fee, the company has no legal title on this property, so the company cannot use this asset. Both PPE and intangible assets, they can be acquired through different transactions, mostly from purchase. Some of them can be from self-construction, donation, business combination, leasing contract, or exchange. In different circumstances, the accounting treatment are different. So when we record the initial cost or the acquisition cost, we include the purchasing price plus all the expenditures that are necessary to bring the assets to its desired condition and location for use. These are expenditures, but they are not reported in the income statement as expense. Instead, they are recorded as assets. This procedure is called capitalization. We basically capitalize this cost to assets, or we deferred the expense recognition. So these long-term assets, property, plant, equipment, intangible assets, will be depreciated or amortized in the future during the useful life of these assets. So that's the cost allocation. Let's use the cost of equipment as an example. When the company acquires an equipment, assume it is acquired through purchase. So it includes the purchase price, sales tax, transportation cost, expenditures for installation and testing, legal fees to establish title, and any other costs. So the sum of these costs will be the initial book value of these assets. The total of these costs is the acquisition cost of this asset. And these assets will be reported in the balance sheet. For equipment, we will recognize depreciation in the following accounting periods. Depends on the expected useful life of this equipment. In this slide, we are given 5 costs, 5 numbers. One is purchasing price, freight cost for transportation, shipping insurance, installation and mounting cost, and the cost of the trials. So these costs are all necessary. So we will record the sum of them, 65 or 100, as the initial book value of these assets. These expenditures will not be recorded as expense in the income statement. They are recorded as assets. We are asked to calculate the amount this company record the purchase of equipment. Purchase price, transportation cost, installation and testing, all of them. Because they are all necessary to get the assets ready for intended use. So the answer is 57,900.